So hi guys, thank you for being here again. Let me admit all of them. Yeah, so this is our fourth masterclass session for this week's topic. It's finance, it's our numbers, and it's really important that you get this right. So, and you can ask everything that you want, I hope, to Clara. So Clara, well, we met like 3 years ago, something like at whole price, you already know whole price. She studied finance at Holt University, Holt International Business School in London. And she's Argentinian, and she studied, did I say it already? Finance. Okay, so she's a rock star, I swear. I mean, we have experienced the accelerator program before, and she knows about entrepreneurs, and she knows, how to create, early stage ideas, early stage enterprises. And yeah, okay, so just welcome, Clara. Thank you for being here, and it's your time.
Thank you, Billy. First, thank you, Billy, for inviting me. And as she said, any questions that you have, feel free to ask me. If I mention any concepts that you don't know and you haven't heard, and I'm not explaining them, stop me and let me know if you have any doubts. I'm not sure I can see the chat while I present. So Billy, if there is any question in the chat, let me know. And so let's start. What I'm doing today, I'm gonna present 3 sets of slides with different concepts. I try to concentrate the things that I find most important when you are an entrepreneur and you're not a finance person and you need to know something. So knowing your numbers is very, very important, especially if you have a business, so that you are clearing where your company is going. So that's what this class is about, is for you to start understanding the concepts you need to keep in mind in your company, even if you don't know finance professionally. The first thing, if this allows me, is unit economics. So unit economics is a basic concept that if you're an entrepreneur, you should be aware that it exists and you should know your unit economics in your own business. So what is unit economics? It's the effect that each unit that you sell will have in your revenue. And you calculate your unit economics as a contribution margin. Contribution margin is the price you sell each unit of your business minus the variable cost that you have. And here there are many concepts that is pretty important to have clear in mind. Variable costs are not necessarily the cost of your unit, like the cost of goods sold. It's not the same concept. So you can have a variable cost in your SG&A, which is the cost that goes in your operating expenses in a P&L, for example. So your variable costs are costs that move along with each unit that you sell. So if you sell one more unit, you have X amount extra of cost. If you sell one less, you have that same amount less. But sometimes if, for example, your company has a system and then they charge you per unit that you have or per customer that you charge, that would be a variable cost, but it's not a cost of sale. So it's very important to have in mind that it's not the price minus the cost of sales, which gives you your gross margin. In this case, it's your price minus your variable cost. If any of that is not clear, let me know, and I can go back to any of those points. Why do you need to have your unit economics? And I highlighted here 3 points. The first one is, it's your step 1 to forecast your own revenue. The second one is that it will help you optimize your products. And the third one is to assess the market sustainability to get the future performance of your product. What do I mean with these points? What I mean is when you see exactly how much each unit that you're selling is costing you, you can analyze whether that is efficient or not, whether you should cut that cost a little bit. You should assess in your market research whether your price is too high comparing with your competitors, or whether your cost is too high comparing with your competitors, and then adjust accordingly. It's not bad if your price is higher than your competitors or your cost is higher, as long as you know why. If you do have...
Ibrahim, do you want to say something? Do you have any question?
Oh yes, I didn't get the beginning very clearly.
Okay, which part? What the unit economics is, or how do you calculate it?
Yes, the economics aspect.
Okay, so the unit economics is when you have one item that you sell, you find which one is your unit. For example, if I sell phones, one phone is my unit. So the price I sell my phone for, I reduce all my variable costs. And that will give me a contribution margin, which is the margin that each unit that you sell is giving to your revenue.
All right, but I am running a service-based business. I'm an IT training center. How do I get the unit cost? It's a service-based business. We offer services, not products.
I'm not sure I understand. Sorry.
In the case of a service business like IT training center.
Oh, well, that's a key point, actually. That's a very good question. One very important part of your unit economics, and you will see it here, no, not here, but in the next one, is that you do need to find what your unit is. For example, if I'm selling trips, that's a service, but then what is my unit economic? Is it each trip, or is it each person that travels, or is it each booking that I get, or is it, but that's something that you have to define in your own business. Okay. There's no rule. It's actually more about you knowing your company and analyzing which one would be the best unit for you to base your assumptions on.
Okay.
But probably the main question that you need to make yourself is like, what am I selling, or what gives me revenue?
So is it going to be based on the amount of time that a client stays in my startup, or is based on like the number of trainings? That would be my unit cost.
I would need to know exactly how your business works to answer that question, actually.
Basically, people register to learn how to use the computer over here. So some come to learn how to use Excel. That's a badge. Another people come to learn how to code. That's programming. That's another side. Some people also come to learn networking. This another area.
If people subscribe for a service, one option would be that each subscription is a unit. One other option would be, probably each subscription would be a unit, unless you want to make it as each people, but then if they renew is a different unit. I would need to know a lot more about your company to understand exactly. I don't want to give you an answer and then it's not the correct one, because I don't know your company, but I would say subscription sounds like the best option in that case.
Good, that's okay. I get you.
Good. So is that okay?
Yeah, I'm okay.
Okay, good. As I was saying before with the 3 points, here what you need to know is know your market. So when you do your market research, you will find out which ones your competitors are, and you know what prices they'll sell for. And you can tell with this comparison whether your product may be overpriced or undervalued. And the difference that you have in prices or cost with your competitors, it's okay as long as you know how to justify, you know where it comes from. And here I put 5 different points that I need you to keep in mind if you do unit economics, because what we are seeing here is it's the basic concept of what it is. But the first part is keep in mind that you are not having any fixed cost. That means that you need to have clear your fixed cost. So after you get your contribution margin, do analyze how many units you need to sell to cover your fixed cost. So if you have a $10 unit and you spend $5 on variable cost, you have $5 extra that you need to use to cover your expenses. So depending how much your fixed cost is, how many units you need to sell minimum to cover all your costs. Remember also that at the beginning of your company, most likely you are not going to cover all your costs, and that's okay as long as you have a long-term plan on how to cover your cost in the long run. Billy, is there a question?
Yes, Luisa is asking, like, what is a price per unit? Thank you, Martin.
Your price per unit is exactly the price that you charge your clients for your unit. Good? Okay. So the second thing you should never forget is that cutting costs may affect quality. That's not necessarily a bad thing. It depends on what your priority or your value proposition is in your company. So maybe when you do your contribution margin, you find out that you're spending too much per unit, and you go and see, okay, what am I spending on? What is the highest cost? Do I need it? Do I don't need it? Is there a cheaper version? But when you go for cheaper versions, remember which one is the minimum quality that you want to keep. If you don't want to, if you are okay, you feel okay cutting a cost because the quality that you lose or whatever you lose is not a big deal for your product or the service you're offering, that's okay. Or if you are okay losing some quality, that's okay too. I mean, some companies compete on pricing and some other companies compete on quality. So the important thing here is to know what your company is having as a value proposition. The next point is that unique economics helps you with your revenue but not your profit. And here I want to ask everyone if you know the difference between revenue and profit, or if you want me to explain it.
I think it would be good for you to explain it.
Okay, so the revenue that you have in your business is literally when you multiply the price of the units that you sell times the units that you're selling. So literally what clients are paying you, it's your revenue without VTA. That's your revenue. But that's not your profit, because after you get that revenue, you need to pay all your costs. And then you have two different types of revenue. So you have your net revenue, which is your final revenue. You already paid taxes, you pay interest rates, you pay cost of goods sold, and you also paid OPEX, everything. OPEX is operating expenses, if anyone didn't know, which includes rent, services, salaries, everything you have to pay that is not directly related to buying the unit that you're selling. I'm sorry, my dog. Then we have the operating profit, which is, give me a second. I'm sorry, I'm doing home office and my dog is here. Then you have the operating profit. The operating profit is the one that you get from your revenue minus the cost that you had on obtaining the units that you are selling. Do you understand how that means? So I'm selling pens for $10 and it costs me $5 to get that pens or produce that pens that I'm selling. So you have $5 of operating profit. But after you get that profit, you need to pay rent or salaries or electricity or I don't know, anything else that you needed, the computer that you're using, everything. And after you pay all of that, that's your net profit. That's the money you take to your pocket. Okay, so that's the difference between revenue and profit. And that's a very important difference because some people believe that because their business is selling a lot and they're making a lot of revenue, they are rich, and you're not rich yet because you have a lot of debt and a lot of things to pay. The next thing, if this works, is getting your unit right. That's the thing that we were talking a couple of minutes ago. You need to understand your business so well that you need to be able to tell me what your unit is. So this is what I sell, and what gives me revenue is X. That is your unit. And no one should know your unit better than you do. You need to understand your business, everything in your business. And then the last point that I think I already mentioned is that you need to make sure you choose the right market. What I mean with this, we can't compare Gucci with Zara because they are not looking into the same market, but they are doing the same thing. They are selling clothes. But if you are a Gucci and you're comparing with yourself with Zara, you will come and tell me that my costs are way too high and my prices are on the sky. Why? And that's because you're not comparing yourself with the right market. So when you choose your unit and you get the market in which you want to get your unit economics compared to, you need to make sure you choose the right market for your product or business. That would be all in this first point of unit economics. I don't know, Billy, if there is any questions.
Yes, we have one question. Is it right to modify your unit as your company grows?
Yes, definitely. I mean, when you do units economics, you do units economics today. That doesn't mean your units economics is like that forever. And that's a very good point to know. When you're at the beginning of your company, you will do some things to sell more or to enter the market that you cannot sustain forever. And if you understand what those things are, you at the beginning will have a unit economics with a cost that is higher because you are doing this, whatever it is, to sell more and enter the market, that you know that after you won't be able to do it. It's like if I do a delivery services and I said I am doing it myself and I go take the books to your house and every client that I have, and then I want to span to the rest of the world, I won't be able to be traveling everywhere telling my stuff with me. So that's something that you do at the beginning to get to know your customers, to get sales going, but then at the end you stop it because it won't give you much revenue.
Awesome. Regina is asking, if you want to offer a consultancy service, how do you establish your unit? What should you consider?
One way of doing a consultancy business is to take it as a project. So if you take each consult as a project, that may be, but I believe that would be a little bit difficult because one project may be very hard from another. So maybe taking hours, our man hours. So, okay, this is project A, it's taking me 5 hours. So I take the resources that I'm spending per hour. That would be one way of doing it. Another way of doing units economics, which I don't have much experience with, so I can give an intro, but I'm not very knowledgeable on that one, but it's counting your clients. And then the way you do it is that you take an average lifetime of a client. So a client of mine, my business would be my client for 1 year, 2 years, 3 months, whatever you expect your clients to stay with you. And then you take your unit economics based on how long or how much it costs you to get your clients. So how much it costs you to get it at the first place, and then you compare it with how long it's gonna stay, and more or less that gives you your unit economics, but I'm not an expert on that one.
But for example, Clara, with the hours, like how do you, it's have been like very difficult for me to establish like how much should we cobrar for every hour, because they tell us like first, like calculate how much do you need to survive and divide it like with the team members, and that would be like your cost per hour, or like doing a benchmark. But like, for example, in the consultancy service, I don't know how to make a benchmark with another services that have been operating for many years, and we would be like starting. How do we define the price per hour?
That's a good question, and it's not easy. But remember that a benchmark, it's just a guideline. It's just a guideline. It's not. It has to be equal to. So when you take a benchmark, which industry would be the best option for you? So try to find a business that is as similar as yours as you can, and then try to justify the cost that you're having. So if your business is going to be more expensive because they are in business for longer and so they have economies of scales and you don't have them, that's okay, as long as you know why and where and when you start having your economies of scales. Knowing how much human time costs, it's very difficult because there is not really a right answer, but you need to flow a little bit with the market in which you're working. So more or less, your competitors, how much are they charging? Do you want to be cheaper to start with, or do you want to be more expensive and attract a different kind of clients? But do start with the benchmark of how much are other units costing. I'm not sure if that helps you.
Yes, thanks.
No problem.
We have another question, Clara. Luis is saying, if we consider different products, would we have to consider them as a separate unit?
Yes and no. Yes, in most parts, but then you do have to understand the variable cost links to each unit. So that's a little bit more complicated equation, but then what you do more or less is that you take, for example, one of your units, you cannot, if you have unit A and unit B, each unit has its own cost, the cost of production. You cannot mix the cost of production of unit A and unit B, that's first, but then you will have some different costs that will be variable with both units. If you have those, which may be the case or not, that's a little bit more complicated, but you need to assign weights or values to one product and another product. So depending on how many units, depending on how much it's costing you, how much you're gonna produce. If you're talking about variable cost of factory usage, if you want to do it like perfectly fine and you are having a factory usage with hours, then you have to consider how. But if your variable costs are completely independent one to the other, then your job is much easier.
Clara, I think we lost you like when you were saying the important part. You need to consider what?
So if you have two products, think about what cost is related to which products. So if you have product A and product B, and you have, I don't know, factory costs because you're producing them, and then you do them both in the same factory, so you just pay one a month. In that case, your life is going to be a little bit more difficult because you need to understand how many hours of production do you have in cost in product A and B, and then distribute that cost based on that assumption. But if all your costs are divided in your unit A and your unit B without mixing, then your life is easier and you just can do unit economics of product A and B without considering anything else.
Okay, thank you very much.
No problem.
Luisa is asking, so you would do one unit economics for each product?
If you have different products, yes. Remember, you choose your unit. So your unit doesn't have to be, I mean, if I sell a bag with phones and computers on it, I don't have to do units economics on phones and computer because I'm selling a bag with them inside. So I just do the units economics of my bag, whatever it is inside, because that's my unit. But you define your unit. Your unit doesn't have to be one object. It just has to be whatever you find is the unit that you are selling. So if you were to sell one, if you're asking yourself, okay, I tell you, give me one of what you sell. What are you gonna give me? Whatever you give me, that's your unit.
Okay, and Gustavo is saying, was that clear, Luisa? Okay, so Gustavo is saying, can we compensate losses in our variable costs?
What do you mean with compensate losses? Remember that when you are talking about losses, you're talking strictly about the P&L, which is the profit and loss statement, which has your revenues and then has the cost that you have for getting that unit. It gives you a gross margin, then you get your operating expenses and gives you an Evita is called. I will explain Evita later. I know the concepts are a lot and pretty overwhelming, but when you talk about variable costs, remember I told you that we have to differentiate what is my variable cost from what is my cost per production, which is not the same thing.
He's saying that charging more or spending less into other areas of production, such as electricity, for example.
Electricity well, depending. If you have a factory, it may be a variable cost, but most likely it's not. Like if you are paying rent in an office and paying electricity for that office, most likely that's not a variable cost. So it doesn't get into your unit economics. It gets into your fixed cost that you take after you get your unit economics.
Okay, and Jayan is saying, how can we set the unit price if our product is a free app and we profit a percentage for the service provided, which we cannot predict?
The percentage that you are getting. Your revenue comes from the percentage that you are getting for the service. So your unit is not the app, is the service.
Is that good, Jayan? And considering that each professional that does the service charges a different, what? And considering that each professional that does the service charges, that does the service charges a different price, if we consider it.
But are you charging the price or is someone else charging the price? Because if you are charging a commission to those professionals, it doesn't matter how much they are charging because your commission is a fixed percentage.
Yeah, I think that would work. No, Jayan? Yeah.
So here is the price of the unit, but let's adapt everything to your own business. So if your business has a percentage, then take it as a percentage and you can use an average price that you get, or you can use an average thing that is charging. Something that happens a lot in finance, and I will show you in the next point, and people that are not professional financial people get uncomfortable with, is that you have to make up most of the things from nothing. And that's a little bit of an art, but you need to start feeling comfortable with that. And that's, if there are no more questions in this one, we go to the next point, and then I explain to you that part a little bit. The next part is about your budget. You need to create a budget and you need to follow your budget. So Your budget will be a guideline. So you make your budget in December for the next year, you know, and then you need to know your numbers in order to make a realistic budget. If I don't know how much is costing me anything of what I'm producing, then I cannot make a budget because I'm gonna just guess, and that's not right. So that's task one, homework one, is know your numbers. You need to know how much something costs you, where are you getting something, what do you need, what you don't need. So here is, what do I need to know to create a realistic budget? I'm gonna tell you 4 points here, and then I'm gonna illustrate them with a super easy example. And then if you have questions regarding your business, then we can try to make it up with your plan a little bit. But the first thing that we need to consider are our constraints. Our constraints are most likely the same for everyone, which is time and money. In our super easy example, we have to go to lunch, and we have half an hour lunch, and I just brought $5. So I need to go to lunch for $5 in half an hour. So those are my constraints. I already decided my constraints. I identify them and I'm using them. The second point is to make assumptions. And here is when the guessing comes. You do need to make assumptions. For example, when you make assumptions, you make them based on previous knowledge. It's not just, okay, I do whatever I want. No. Research and do assumptions that have a justification. So you need to know and understand your assumptions. But for example, in our little game, I'm going for lunch. I have $5 and half an hour. Last week, I went to eat in the corner and I spent $4.50 and I took 20 minutes. So my assumption is that if I go to the same place again, I'm not going to spend more than $5 and I'm not going to take more than half an hour because I already went there and I managed to do it that way. So I assume I'm going to be able to do it again. In every assumption, there is a risk. It may happen that today they're super packed full, or it may happen that yesterday they raised their prices. So I go and I can't eat there. So that can happen and that's okay. But because I know my assumptions from the beginning and I understand the risk that my assumptions is bringing me, I can go and I can have a plan B. So that's our third point. You need to have a plan. So I know my assumptions and I understand them. I know that I am assuming that the corner shop is going to have the same price and spend the same time as it did last week. Now my plan is going there. But what happens if I get there and it's closed, or there's too many people, or it's more expensive than I thought? Then I go and find another place, and I know that there is another one, I don't know, 2 blocks from there, and I can get walking and whatever. That's your plan B in case the worst case scenario happens. But I can make a plan because I already know my assumptions. Sometimes we already make plans without thinking of the assumptions that we are making. We just say, oh yeah, let's go to the corner, but you are not thinking about why you are going there and not somewhere else, and if that is really your best option. Once you know your assumptions, when something happens, like COVID, then you know where to attach your business. And the fourth point is milestones. This one, it's for every entrepreneur. Milestones must be like the golden word for everything. Your company should the plan you have in your company should always be based on milestones. If you're thinking that until you get that thing that you need to get in 5 years, you're not starting, then you're never starting. So divide your plan in little milestones. And here, when you keep it in the financial side of the milestones, you need to keep track of the achievements that you are making with your milestone. And most importantly, each milestone that you reach needs to be adding value to your company while reducing risk. So when you get any milestone that you propose to your business done, it has to be such the effect that you already added value to your company. More value in your company will almost, without anything else, translate into reducing risk. And that is what an investor wants to see. So keep track. When you go see an investor, show them, this is where I was 1 year ago. I met this budget and I ended up with this plan. This was based on these assumptions and we got these milestones done. With these milestones, I added X, Y, and Z value to my business and I reduced ABC risk in my business. So it doesn't have to be a super complex financial analysis of everything. It just needs to be true and it needs to be something that you understand. If you understand it, I promise it's pretty easy. And then, the second point is, what do you need to see in your budget? This one is a little bit more financial. What I would recommend is that you do a little bit of study of what a P&L looks like. If you don't have financials, most likely no one is gonna give you money. So you do need to understand how to build your finances a little bit. That would be a whole complete other class. But I do have here a little bit of the things that you do need to keep in mind, and just so that I can define some concepts and help you with them. So the first one is how much you plan to sell. As we said before, that's your revenue. So simply the units that you're selling times the price you're selling it to, that's it, your revenue. How much you plan to spend. COGS means cost of goods sold. So that's the cost directly related with producing or buying or obtaining your product or service. Then you have the SG&A. SG&A means service, general, administrative. It would be in your operating cost. That's where you put your rent. That's where you put the money, I don't know, the money, your electricity, or buying books, pens, the office, whatever, everything, almost everything goes there. And then, I don't know, what else I put here? The CapEx. CapEx is your capital expenditure. So if you buy capital, which would be buying a building, buying a factory, or building a factory even, buying computers, buying anything that you can depreciate would go into CapEx. The third point is that you need to know your monthly Evita. Your Evita means earnings before interest, tax, depreciation, and amortization. In Spanish, in English, more or less, not in Spanish. In English, that means everything you earn before you pay interest in any debt that you may have, before you pay tax in any tax that you may have to pay, and before you count any depreciation or amortization. Depreciation and amortization, for anyone that doesn't know it, it's the value that a fixed, like a computer or a building, is losing over time. And that's not cash flow, that's not money that you pay, it's just value lost. So you do take it as money, as something that you're losing, but because it's not cash flow, you don't pay for it, then it's not as important to consider it, and it may give you tax benefits. That's another whole class also.
Can you repeat the meanings of
Evita?
All of it. The first one was cost of goods sold. No? Then capital expense. No, the second
then
one
is service, general, and administrative.
Wait. Service, general.
Then CapEx is capital expenditure. And then Evita is earnings before interest, tax, depreciation, and amortization.
Okay.
You learn it, I promise.
Guys, but here it is.
Now, the last point is how much taxes you need to pay or not. And when I say or not, I don't mean let's avoid taxes and pay taxes in the country that you I mean is
let's avoid what?
I don't mean that we need to avoid taxes in a country, you know. What I mean is when you have an Evita which is negative, your taxes are calculated over your Evita. That's why I mentioned it there. When you have an Evita which is negative, you won't pay taxes. In most countries, let's say, because I'm not an expert in all countries. So because you have negative, you will have a tax credit. So it's gonna be like the government owes you tax. You don't owe them. In some countries, they do pay you that tax that they owe you. In other countries, what you do is that you move it over time. So for example, if I have 2,000 of loss and next year I make 1,000, then it's like I didn't make any money. I don't pay taxi for those 1,000 because I already moved them. Do you understand what I mean?
No.
No. So you have -2 and then you make 1 and that gives you -1, right? So -1 is still negative, so you still don't pay taxes. So as long as you are losing money, you are not paying taxes and you are getting tax credit. And that is a little bit of a more complex topic, but that's how you can earn more money in the long run by avoiding paying taxes using your loss.
But that's like in the long run, right? Like they don't need to do this like for setting, I don't know, like the business model or, you know, the budget. Or should they consider it for their budget in an early stage?
Yes and no. If you're gonna see an investor and present financials, you will present a P&L. When you present a P&L, which is a profit and loss statement, then you will see your EBITDA and you will see your taxes. And it's gonna be 0 because at the beginning you're not be making money. So yes, you don't need to complicate yourself with that, definitely.
Just by
so then I do a little bit more of a reality check here. And this is especially important if someone else is doing the budget for you. It is as bad in budgeting making to spend more than it is to spend less than your budget. If I budgeted $1,000 and I spend 9,000 or 11,000, I still made it wrong by 1,000. So that's equally wrong. Of course, you will tell me, Clara, yes, but I prefer to spend less than I had budgeted than to spend more. Yes, but be careful because some people may inflate cost so that the budget looks X and then they tell you, oh, I spent less than the budget. But that means you don't know how to budget. It doesn't mean that you save money.
Okay. That's a nice one. Makes sense, actually.
And so here is, okay, so now you tell me, Clara, okay, yes, but in December, I didn't know COVID would exist. Like, of course, my budget is wrong this year. So what happens? That's when you do a forecast. A budget is a kind of forecast so that you understand, but a forecast is a look into the future. So you decide how much you think you're gonna spend. So a budget, it is a kind of forecast, but when you make a budget, you keep it. It's always there. You keep your budget, and then, for example, in the company I'm working in right now, in March, we had to do a forecast. Why? Because COVID. So of course, the budget that we had in December last year has nothing to do with reality today because there's a global pandemic. So of course, business changed. So your budget doesn't mean that you have to stick with it no matter what. But if you understand your budget and why you made it, after that, if you think something is going completely wrong, and that's when you need to keep control of your budget, then you do a forecast and you say, okay, there is a new reality like COVID, or my rent is gonna be a lot more expensive, or I was expecting money that didn't come. So I redo my budget, but it's called a forecast. So you do again from now on how much you think you're gonna spend until the end of the year. On the end of the year, you compare them, the three of them. You compare your budget, with your forecast, with your reality, to see if your adjustment that you made was justified or not, and you can analyze if you did your numbers correctly. Sibili, pregunta? You are mute.
No, they don't have. Or do you have any question, guys? As of now, you can open your mic as well.
Not me, because this morning I have a very white voice.
Oh, I mean, he's Martin. He's our
Hey,
master
Martin.
trainer.
Hello, how are you?
I'm good.
Do
Sorry
you have
for
any
my good
questions?
voice this morning or this afternoon.
Sorry?
I'm sorry about my deep voice this morning.
Yeah. Are you sick?
Some kind of. I feel not bad, but my voice is so deep.
Okay, we do have a question. No. Yeah, Khalid. Please, will you share your slides? Yeah, of course.
Definitely. Yes, yes, yes. And then this is our second set, big set of slides is finished. And now we have the third one, which is the last one. So if you have any questions about this one, let me know. Otherwise, we move to the next one.
I think we can move forward.
Okay. Now, spend wisely and watch your cash flow. This one is important. You need to know what you're spending your money. So how do I spend wisely? I made 4 points for you to consider. Most likely you can think of more points to consider. Identify your most important cost. What is that cost that makes your business? So even though it may be expensive or not, you need it. Identify your biggest cost. Which one is my highest cost? Do I need it to be that high? Do I need that cost at all? Identify your vital cost. Here, most likely is more than one. So I don't know. If you are a startup and you are now paying rent for a co-working and you are 2 people, do you really need to be paying rent for a co-working? Maybe not. So maybe if you're running out of cash, while your business is healthy and you can pay it, go ahead if you want. But if then you're running out of cash, that's the first cost you need to cut because you don't need it. You can work from home. That's okay too. And the fourth one, and this one, let me explain a little bit. Understand what you can cut for free and how much it costs you to cut something that is not for free. And what do I mean for free? For free, I mean that it doesn't affect anything. So, for example, if you're 1 or 2 people working in a co-working, you can cut that rent and it's for free. That nothing is going to happen. You can meet your partner at your house or in a coffee shop or whatever. And unless you have a really special circumstance in which you need to be in a co-working for sure, that's a cost that is going to be for free. When to cut or not cost for free, that's up to you and the administration that you give to your company. How much it costs you to cut something else? Here it comes with like the cost we talk about, variable cost and getting quality out. Maybe I can change the supplier, but if I change the supplier, the quality is a little bit low. Do I want that quality lower or not? Can I afford it or not? Is my value proposition quality and I'm cutting it? Is that right or not? So understanding if you cut something, what happens. So I believe when you're working on a startup, knowing like dollar by dollar, everything that you're spending on which, why, how, it's super important because then you understand everything. When you have a problem, you know where to cut first. When you have a healthy business, you know where to put money first because you understand your money perfectly. The second point is, this one is for free. It's also a personal finance advice, but there is a 50-30-20 rule for healthy financials. And that one works personally as well. So if any of you has problem with their financials personally, use it too. So 50% of your expenditure should be needed, 30% wanted, and 20% saved. So most of the money that you expend has to be in things you need. And then you have some extra money for things you want. I don't know, let's put the office that you're using, let's put it beautiful. Let's paint it. You don't need it, but it's nice to have. Or I'm selling something and I add an extra feature, and that feature doesn't really add value to the customer, but it's nice. So then I want to have it, but then it costs me money. So that would be in wanted. And then the 20% that you have left is for savings. Save money because you will need it in the long run. And that is my last reality check. Companies don't go bankrupt because they don't make profit. They go bankrupt, because they ran out of cash. So you may be not making profit for years and years and years and years and never go bankrupt. But if you don't have cash today, you're done. That's it, the end of your business. So that's why the 20% of your expenditures needs to be saved. You will tell me, Clara, I just started. I can afford to save 20%. I need to be investing everything. Okay, that's fine. That also depends on the administration you want to give to your customer, your company. But I give you some advices here of what to be careful of if you are not saving the 20%. First, and when I mean saving, be careful with that. I don't mean having a bag of cash in your mattress, because that doesn't work either. That's cash you have stuck and it's not making money for you. That's not savings. First point, use your budget and forecast to track your revenues and expenditures. So as long as you have your budget and your expenditures, do a monthly cut. Okay, so in January in my budget, I had to spend 100 and I spent 110. Why did I spend 110? Do I need to look back at February again? Or was it something that I didn't think on? It wasn't in my assumptions? Or is there any of my assumptions not true anymore? What do I have to look for? So that if you have a control, a monthly control of what you are spending on, that's it, you're good to go. The second one is very important. There is a difference between a cost that you spent and a cost that you paid. So for example, if I use one of your services and I don't pay you, I spent that money because I used the service, but I didn't pay you, so I'm not losing cash flow. That doesn't mean I'm not gonna pay you ever. That means I have an agreement with you. So that's my third point, make payment agreements. If you have suppliers or you have, I don't know, a fixed cost that you know you have to do every month, have some payments agreements. Don't mix up your payments agreements. Have suppliers that you pay from the 1 to the 5th, suppliers you pay to the 20 to the 25th, so that your cash flow doesn't, if you pay all your suppliers on the 2nd and that's all your money, then on the 3rd you're bankrupt. But if instead of that, you still use their service, but you make a payment agreement in which you pay 15 days after the service or 30 days after the service, or you pay half and half, that's gonna be a healthy cash flow. But the cost that you incurred is the same. You spent the same money, but you gave, you paid, you lost cash flow for a different amount. And that's key for healthy financials as well. And then last point, but definitely not least, raising capital, and you probably know it, is not easy and is not quick. So you need to know and have in mind a concept called the burn rate. Your burn rate is the amount of time that you can operate your business with the money you have today. And here, again, you can use many assumptions. You can tell me, well, if I don't have any more capital and I need to ask investors for more money, then I'm gonna use less money on doing this. You got cost, and then I can live for 3 months, something like that. That's your burn rate. So in 3 months, done, capito, finito. If you didn't get your money from your investors, you're done. So you need to have your burn rate clear so that you start asking for money before that happens. And if you do some reverse engineering here, you can get this answer. I think is most important when you're in an early stage, is how much money you actually need for your company to operate X amount of time. When you're looking for capital, they will ask you how much you want. And when they ask you how much you want, you can tell them, well, give me 2 million. I will see what I do with that. Because that doesn't work that way. You need to tell them, give me 500,000, I'm gonna spend X 400 in this, 500 in this, whatever. And you need to give them their financials and the budget and the projections and everything that you're gonna do with their money, the milestones that you have, everything. So to have those 20% of savings work for the time in which you don't have any capital. It has to work from the time, I don't know, you finish with the first investor and then you are looking for the next one. I know you are in an earlier stage and you are not yet on the first one to get to the second one, but that's definitely something I wanted to make sure that you have in mind, because getting your first investor doesn't mean you made it already. It will depend a lot in how you manage that money, how you administrate your business, and what your business is about. Some businesses don't make money for years and years and years, and then they make a lot of money. So pay attention to your financials, know your cost, know where your money is coming from, and know your burn rate. I think that's it from my side.
Awesome. Thank you, Clara. Do anyone have any question? I would ask something in the part that you were saying, Clara, like how do I spend wisely? And you were saying something about like if you are already in a startup, but what happens when they are not a startup yet? Like what should they focus on? You know, like it's like this idea stage.
Well, in that case, you need to think more of imagining like what would be instead of what it is. So what would be a cost, or what are your costs that you cannot live without, that you need to have for your business to start? And also this is key. At the beginning, you will spend money that it's yours, and you will spend your money to get your prototype, and you will spend your money to get, so keep track of that money that you spend, because that's gonna give you your first numbers. At the beginning, you won't spend wisely. You will spend more than you need to, because you won't have quantity, because you won't have relationships, you won't have partnerships, you won't be talking in the name of a company. So you will spend more money. But if you keep that in mind, you know that by the time you are a company, at least you spend the same. You can never spend more than you spent when you were starting with your idea. And then that will help you whenever you need to make your first budget for an investor, because your prototype is ready and you need someone to finance it. And sometimes you can get the money that you have already invested, you can get the investors to give it back to you. That doesn't always work, but it could work.
Okay, awesome. So we do have questions. Sorry, I can't find my glasses. For cash flow purposes, is financial factoring a better option than a simple credit?
What does it mean, financial factoring?
I don't know. Alfonso, do you want to open your mic?
Like when you go to the bank and you have some credits with, I don't know, like a customer promised you he's buying 100 units at the end of the month, and you go to the bank and that's the guarantee of the factoring. That's the financial instrument. Or just a credit based on your I don't know, your factory as a guarantee?
Which with those questions, it will depend always. Depends on if you have something else to give as guarantee. It depends on whether the bank will not give you a credit without a guarantee. It depends on the interest rate that you would be paying, or whether they ask you for something else in return. I don't think there would be one right answer that I can give you that would work with every startup.
Okay, thank you.
And also in that case, you do have to think of the likelihood of you getting those orders and what happens if you don't. Of course, the bank already gives you that risk, so most likely the interest rate for the first option is going to be higher than the second option. And in that case, it would be when you start to pay interest rate, when you start paying your capital back, so that it doesn't affect your cash flow.
Okay.
So always try to negotiate that you start paying capital back on debt in a longer time, so that you can make money now and start paying when you have more positive cash flows.
Yeah, great. Thank you.
Thank you, Alfonso. Luis is saying, can we estimate the cost from research?
Definitely. You can do anything for research. Like I told you before, a little bit of finance is an art. We, as financial people, make up most of the things that we put in our Excel files. The important thing is not the number that you put, but that you know how it affects you. So for example, if I have 3 costs and one of them is 1, the other one is 50, and then the other one is 3, if that one is 1 or 2 or 3, it doesn't affect my model much, because it's just a small cost comparing with the other costs that I have. So it's not something I need to look deeply to get the exactly right number. If it's 1 or 1.5 or 2, it doesn't affect me. But that cost that I put as 50, that one is important because it's taking most of my money. So I need to understand why, how, where is it coming from? Is it okay that it takes most of my money, or it's not okay? So it's more about understanding where your numbers are coming from and how they affect your business than getting the exact right numbers that you need. Because as time goes by, you will get the right numbers.
Okay, cool. Regina is saying, can we make finance projections if we haven't sold yet?
Yes, definitely. So what you do with your projections, if you make up most of it, but you start with your revenues, you know when you're planning to sell your first unit. So your revenues will be 0 from period 1 until the period that you know you are gonna sell your first unit. But before that, those years, you still have some costs that you're making. That's what I mean when I say that you should keep track of the costs that you're making, even when your startup is an idea and it's not a company yet and it's not a startup yet. So keep track, because that's a cost that your company had, even though you're making it in year 0.
Okay, cool.
And for example, sorry, Clara, how can we measure traction even if we haven't sold yet? Like, I don't know, like with investment, when we are looking for investment, maybe not in this stage, but later, how can we just like show them our traction without being like too soñadores?
Being realistic will depend a little bit more on the market that you are in. So use a lot of benchmarks if you really don't have anything. If you really don't have any number at all, you haven't sold anything, try to use benchmarks a little bit to make the growth mainly. But what you will do is, it's your year 0, you will put no revenue. And if you start selling in year 3, then it's gonna be no revenue until year 3. All your variable costs that are directly related with the production or with the selling of the units are gonna be 0. So the costs that you're gonna have are mainly fixed. Fixed. And so those are the costs that you're having. So you're gonna have a profit, a negative profit. But as you move your projections to forward years, what you will do is that revenue is gonna be growing once it starts, and then eventually you will get to break even and it will get you profit. So what you show your investors is exactly when you plan to start selling and why it took you X amount of time and why not before, and then when you break even and why not before and why not after. So knowing why and how and where the number is coming from, it's a lot more important than having a number at all.
Okay, thanks.
Cool. Okay. Luisa is saying, also, do you have any general tips to what look for when choosing or searching a supplier?
Well, that would be depend on what kind of supplier you're looking for, what product you're selling. But something that could help you, a supplier, try to find something that is long-term. Try to sell them your business from the beginning. Not as if they were an investor, but if they would be a partner, they would be a long-term partner. So try to make arrangements in which your growth helps both of you. So maybe you tell them, okay, the price that you're telling me, I think is too high, but it's okay because I'm just starting, I understand. But once I start selling 50 units, I pay you half. And negotiate, make agreements. I don't know, kind of be friends with your suppliers, not friends, but partners. At the end, if they're gonna be, and make sure they don't have too much power over you. Always have a second supplier, always have a second option, or always, because if they have too much power over you and they realize they will do whatever they want with the prices and the quality and whatever, and you won't really have a choice. So don't let them have so much power over you.
Okay. Nice. So Ronald saying, hi Clara, nice to see you here. How can we calculate the costs when an investor wants to buy actions?
That's a difficult one. Hi Ronald, that's Ronald, right?
Yeah.
Yeah, hi, from Peru.
That's pretty difficult. You do need to have your financials clear so that you made a valuation of your own company. If you don't know how much your company is worth, then it's really difficult to know what is a 20%, what is a 50%, what is a 10%. So it's really difficult to know how much money you should be getting for any percentage that they are getting, whether you actually want them to get any percentage, because I mean, if you're getting debt to start Facebook, I don't think you want to give them 50% because then you know how much Facebook is worth. So you need to be very careful, but it's really difficult because you want the money to start. If you don't have it, you don't start. But then if you give them too much and then you start and you're very successful, you will regret it. So there's not right answer. A little bit of follow your gut, what you feel, what the investor makes you feel. Your investor has to be a little bit of your friend. So at the beginning, at least, like you need to have your interests aligned. If your investor wants you to grow and then sell, then maybe you don't want him because you want your company to be your company forever, or maybe you do. If you are lacking X amount of knowledge or X area of knowledge in your team, but then your investor has a good relationship with that kind of knowledge, then that's something that they are giving you also. So it has to be considered inside the money that you're getting. It's not just money. There are angel investors, especially, that give you a lot of knowledge and resources, and that's a lot more than you need, a lot more than money. So there's no right answer again, I'm sorry, but do have your financials in that case. If you don't know how much your company is worth, or if you don't know how much you think your company is worth, then you don't know how much money you're getting.
And how can they value my startup?
Whoosh. That's a whole class, but you have to make your financial statements. You do your financial progressions. The easiest way is doing cash flow, free cash flow statements, and then getting your CFC. That your I forgot one word, but DCF. I don't remember the D and DCF. Discounted cash flow. But that's like, I mean, look at videos, watch videos. There are people teaching you how to do them. Start with your financials, do them as easiest as you can. Just your cost. It doesn't have to be complicated. Anything you see complicated, avoid it. Use benchmarks, use general numbers. No number has to be perfect. Between 100 and 101, it's nothing, so you don't care. Use averages if you have to, that's okay. It's, as we said before, you make all the assumptions that you want. Just know the assumptions that you are making. Don't put 100 instead of 101 just because I said it's the same. Do it because you know what difference it makes, and you know it makes no difference, so you put 100. But know your assumptions. That's the most important part.
Awesome. And Bruno is asking, how many years must the company at least be able to operate with the money it has today?
Most likely getting capital takes you around a year, I think. So I would say at least a year, but it depends in a lot. I mean, when I say the money you have today, it doesn't mean the money I have in cash today. I mean, if I already have healthy sales and I already know the projections of the revenues I'm getting, that's money you have. That's money you can count on. So it doesn't mean cash you have today. It means with the operation as it is today. So if you do have money or you do have profit, then you already may not need that much of your savings. But it depends on how the process of getting capital would be in your country. So you need to be able to work as long as you don't get extra money.
Was that clear? Yeah, he's saying. So, do you have any other question, guys? I think those were all of the questions. Martin, do you have any question, any insight?
I'm so surprised by Clara and the clarity of their words and their concepts and the ability that they have to, and she have to express with the people. Thank you so much, Clara. Your concepts are so clear and so practical. So it is awesome.
Thank you so much.
Yeah,
I'm giving you guys here my email in case you need anything. I am a workaholic, so I do take some time sometimes to answer my personal email, but do write to me if you need anything with no problem at all. And I promise I will get back to you.
No worries, thank you. I mean, yeah.
And also, maybe you may have a lot of questions about this kind of topics, because it's not easy and you need a lot of background in order to understand what is exactly Clara is trying to say, trying to express. But it is so clearly and it is so easy if you understand that money is the blood of your company, the blood of your startup. So you need to understand that, because it is easy to go to bankruptcy if we are running out of cash. So that concept is tremendous and it's clear. You need cash.
Yeah, even me, I understood. Thank you, Clara. Like, I was like super nervous when you said like, okay, 2 minus 1, and I was like, oh, focus, Pilar. Thank you so much.
And no matter if your startup is a kind of social business, you will need money also. So you need to administrate, to management, all the money you have, or you might have, or you.
What I would add, if your startup is social, get good impact metrics. You do need to measure the impact that you are doing. Otherwise, you are not really making impact, maybe, or it's your imagination. You don't know. So do have metrics.
Yeah,
that's a really important one. Thank you. They are saying that they liked your presentation, that it is so useful, and your information was super useful.
I'm glad, very glad.